Hello and welcome to the Financial Puzzle Playbook with your host, Jim Sumpter. I'm RJ Malik, producer of this podcast, and we've been talking, I guess the theme of your podcast, Jim, is basically the 6 puzzle pieces. And you weave it in and out on every single podcast that you do. And today it's going to be you and I, and we're going to be talking about, again, the 6 puzzle pieces of the playbook. What puzzle piece do you have lined up for us?
So, RJ, first of all, great to see you.
Good to see you.
And this today is going to be all about investments.
Okay.
This is a piece of our puzzle that most people are familiar with, and they have in some capacity. Whether it be their retirement account, if they're contributing to an IRA or a 401k or a 403b or a Roth, or they're saving money for their kids' education. Or they may just have an individual, account at, named the custodian. They have some sort of investments, and we are approaching year end, and so I thought it would be good to talk about a strategy or a couple of concepts, and I'm going to sort of dive back to episode 4 when we talked about investment basics.
Okay.
One of the things we discussed there was rebalancing your portfolio, defining your risk, making sure you understood why and what that you owned in an investment. And today we're going to really focus in on your risk tolerance and rebalancing the portfolio. And here's the reason this is important. So I've been meeting with a lot of clients as we approach the year end, and one of the questions that is coming up a lot, because this particular year has been a really good year in the stock market. And so, this time last year, say going into December, January of last year, we created this asset allocation model. And what's happened is the market has been really good, but not everything moves at exactly the same rate and exactly the same pace. So at the end of the year, what we're finding is that a lot of portfolios are out of balance relative to where they started at the beginning of the year and relative to where someone's risk tolerance is. So, RJ, I'll throw a question out to you.
Okay.
When is the last time you rebalanced your portfolio?
We had a meeting about 2 months ago with our financial advisor.
Good.
And
I'm glad to hear that.
yeah, we went over things, and of course we'll meet with him. He also does our taxes. So we'll meet with him again either in March, probably in the month of March, and we'll again go over things. In fact, we have several questions to ask because I'm actually turning 63, and we want to start talking about Social Security and all that other good stuff.
Right.
But, so that's we try to meet with him twice a year.
Okay. So in your conversation with him, was there any discussion about your risk tolerance?
Yes, we always talk about that.
Okay.
And,
Okay.
that's my risk tolerance is much different than my wife's risk tolerance. So our financial advisor has to sort of balance it between us and actually lean more towards my wife because I want a happy wife. You know that saying, happy wife,
Right,
happy
right.
life. So, yeah, we talk about it. And like I said, we probably lean more towards what my wife prefers.
So it's interesting. I have this concept that I talk about. It's the difference between it, and it's why would you want to invest? And I say, okay, let's say you have mattress money, okay? And so you take all of your money and you put it in a mattress, so you're going to get no growth, but you're also going to get no loss, okay? Because it's in the mattress.
Right.
And so you put it in the mattress. As you need money, you take it out of the mattress, or as you contribute and make contributions, you're adding to the mattress. And so what happens is over time, and I show this to clients, is that over time, the growth over and above your mattress money, that's your investment growth. And so
Right.
that's certainly an objective and a goal. We want to have more, at the end of the day or the end of the term than we started with. And so we always talk about that. So I was meeting with a client recently, and exactly to your point, and by the way, you and your wife are very common because it's very common for one spouse to be more aggressive than the other spouse.
Yes.
So I'm meeting with this client, and we're talking about their portfolio, and the market is up X and they were only up Y. And so, they had not quite gotten to the market performance. And then what I pointed out is, yes, but you're not taking the risk of the market. And so, if let's say the stock market is up, 15%, and you're only up, say, 9 or 10%, but you're not taking the risk of the market. So
Sure.
if exactly the opposite and flipped back, if the market's down 15%, you would expect to not be down that 15%. You would expect to be down something less. And so we were going through that, and he was like, well, yeah, that's exactly, I understand that. It's just, when the market's really good, I wish I was getting more. And then I looked at his wife and I said, do you agree? And she said, no, not at all. And and I kind of laughed and I said, okay, so, you're very common. That's very common. And she said, as far as I'm concerned, I would just assume leave it all in the mattress in your example. And so I thought to myself, okay, so we have and this is a couple, they're doing a lot of things right. And, they have their goals and the objectives, and we're working with them through all the puzzle pieces and all of the planning. But we were specifically talking about the investment strategy at that point. And this concept is exactly what we were touching on, because, at the beginning of the year, they may have been in a portfolio, say, where it was 70% in stock and 30% in bond. Let's use that as an example. Well, at the end of the year, because of where the markets had been, they were about 78% in stock, and then, 22% in bond. So what had happened is their asset allocation had become lopsided. And so my question to them was, has your risk tolerance changed? And I think it's really important as we go through a year like what we've seen, or anytime you're reevaluating your investment objectives, is to say, what is my goal for the money? Has my time frame changed? Has my overall objective changed? And, how am I feeling about that? And there's a myriad of questionnaires that you can get online. Your financial advisor probably has some sort of a questionnaire that you've gone through. And, and what happens is you would answer it in your way, and your wife would answer it in her way. You answer it very differently. And then your advisor, or me in this case, the advisor has to say, okay, we're gonna meet in the middle somewhere, and we're gonna kind of talk through that. So, if it makes you feel any better, your situation is no different than a tremendous amount of clients.
It's not a surprise. I mean, I think that's just the natural way that men and women differ on things, and you just have to negotiate and make sure, come to a happy medium. In my case, it's more on her side than on my side.
Well, and and if that works for your family, then that's great.
Yeah.
Something else that you said a second ago is that, you mentioned your age. You brought it up, not me.
Yeah, I understand.
You mentioned that you were 63. So, if you go back to a previous podcast, I believe it was also episode 4, I talked about stages of investing. And we talked about, the accumulation phase, which is from, when you first start working to maybe age 45 or so. And then there's the preservation phase where you're 45 until retirement. Well, that's where you are right now, but you're at the ending part of that preservation phase.
Yeah.
Where you're trying to preserve what you've got, still grow, but preserve what you've got so that you can retire at a point when you want, so that you can go into the third phase, which is the distribution phase. The distribution phase is the one where your wife says, okay, I'm used to getting a paycheck on the 1st and the 15th, so I need my money to be there on the 1st and the 15th. And that's really what a lot of people are concerned about is, as long as I have my money to pay my bills, to do the things that I want to do in retirement, then that's what I'm concerned about. So So, as you're reevaluating your portfolio, as you're evaluating your risk, it happens in all stages. So this
Right.
isn't something that you only do when you're, 63 and meeting with your advisor. This is something that you do consistently all the way through, life. So let me ask you a follow-up question. When you were meeting with your advisor, you mentioned that you talked about risk. Did you talk about your asset allocation and how does that, affect you? And asset allocation in this sense would be the combination of stocks, bonds,
Right.
real estate, cash, other types of investments that you may own. Did you have that discussion?
No, we didn't have that discussion because of who my wife works with.
Okay.
So
Okay.
we can't invest in individual stocks.
Okay. Gotcha. Okay.
Okay,
Okay.
because
Okay.
she works in the financial media part. So
Right. Right. Right.
that's that. So we just have basically a mutual fund and go from there.
Right, right. But you're still talking about, so the mutual fund, and, anytime we're talking about a mutual fund, that's a combination of investments. So a
Right.
combination of stocks or bonds or whatever the objective of that fund is. And, so just because you're invested in a mutual fund doesn't mean that all mutual funds are created equally.
Right.
You may have a mutual fund that invests 100% in stock, and you may have a mutual fund that invests 100% in bonds, or you may have a fund that invests in sort of both, but then there's different allocations and everything like that. So, it could be a mutual fund, it could be individual stocks, it could be an exchange traded fund, it
Right.
could be a myriad of investments that make up your asset allocation. And so, I think it's always important to look and say, okay, what does my investment invest in? Do I understand what the risk is for this particular investment? Or if I'm going to, say invest in 5 different things, I don't want them all to be the same,
Right.
because then you're not diversified. And so you get a year like this year, if everything goes up at the same time, at the same rate, you're not diversified.
Right.
If you think about that,
Mm-hmm.
because you're clearly, if everything goes up at the same time, or if everything goes down at the same time, then you do have all of your eggs in one basket, as the phrase goes.
Yeah. Yeah. That doesn't happen with us, and unfortunately for me, or for this episode, my wife pays more attention to it than I do. I
Okay.
basically talk to our advisor twice a year, and that's about as much attention as I pay to it, which probably is not good on one end, but I can't tell you how many times I've had to calm my wife down because she's looking at it at a regular basis. So I guess we balance ourselves off a little bit, but I'm aware of what we do with our financial advisor. We've been with him for a number of years, and we are pleased with the approach he takes.
Right, right, right.
Hi everyone, I'm Cassidy, the second C in CMC Financial. So Dad sometimes gets on a roll with this podcast and might forget to remind you about a few things. 1, don't forget to like and share this podcast and leave a review. 2, follow CMC Financial on all of the socials, Facebook, Instagram, and LinkedIn. And 3, go check out the website at cmcfp.com. Okay, back to my dad. He's probably still talking.
So, RJ, let's take that, what you just talked about, in that you're more kind of hands off, except for a couple of times a year. Your wife is more hands on, except a couple of times a year. When you look at investing, I always talk about, there's different questions that you need to ask yourself, and this is true whether you're, in your case, where you're sort of hands off, or in your wife's case, where you're sort of hands on, and this comes down to risk tolerance, because, there's a lot of people that look at their statement every week. Or their account every week. There's some people that look at their account when they get ready to meet with their advisor. So if that's twice a year or once a year, that's when they look at their account. Okay, so that's RJ. Okay. So, you may not have, you may have heard that the market had gone up, but you may not have realized exactly what happened and how does that affect you and so on and so forth. So where I'm getting at, you always have to ask your question of, am I comfortable with a level of risk? And what does that actually mean? It means, can I afford to lose money or have money go down if the market went sideways or if the market went down? And in your case, at your stage in life, in that preservation phase, approaching retirement, your risk tolerance is very likely different than it was when you were in your 30s. Because for your retirement money, when you're in your 30s, you have maybe a 30-year window.
Right.
Whereas now your window is much shorter.
Yes.
So you can't afford to take the risk of a big downturn if it were to happen. And so that's a question you have to ask yourself is, am I comfortable with my level of risk and can I afford to lose money in a period of time? The second question I always like to ask is, do you really understand what you own? Now, I'm not saying that you're going to read, every page of all the prospectus that come into the home that, is 100+ pages with all the jargon, all the information, you're not going to do that because most people don't.
Right.
But I do think it's important to conceptually understand, what is it that I own? Do I own an investment that invests in stocks? Do I own an investment that invests in bonds? Do I own an investment that invests in real estate? Or, here's one, does this investment invest in something like Bitcoin or crypto? If you don't understand that, don't invest in it. And that's one of the things that I think a lot of people, because we've all been hearing in the news, this great rise of, XYZ investment and so on and so forth. Just because it goes up doesn't mean you need to go jump into it.
Right.
But if you understand it, if you're comfortable with it, if it fits your level of risk, if you can afford to take on that risk, sure, invest a little bit in it, but with an asset allocation. And so that's another question that I have is, should I get advice on this? Should I talk to a professional and have them help me evaluate it? You do. You meet with your advisor twice a year, even though your wife in her job is in a position to where she's probably very capable of evaluating things. You still meet with your advisor, so you're trusting that extra layer of advice, and you're trusting that extra layer of oversight, if you will.
Yeah, and it's good to have another, I guess, I'm searching for the right word.
Set of eyes.
Yes, yeah,
Yeah,
and a different outlook on things.
Mm-hmm. Absolutely.
And we understand what his outlook is. He's fairly aggressive, and we're fine with that. And we'll see how we go. Probably because I'm looking, I'm not retiring anytime soon because, as we've talked before, as long as my voice holds out, I'm working because I enjoy what I do.
Right.
So, these are things that I will have to discuss with him, as I get older and I hit certain ages, and, you got Social Security, all that stuff being thrown in, how am I going to protect myself? Am I going to be at a point where I can only make X amount of money before it's not worth it for me to be working that hard, that type of thing. So these are thoughts and questions that are I'm starting to formulate in my head.
Well, RJ, something, this podcast, we talked about the puzzle piece of investments, but what you just did is you brought in the puzzle piece of retirement. You haven't talked about the tax implications, but those are always out there. Yeah. And then there's always the puzzle piece of cash flow that I always go back to, because no matter what stage in life you're at, it's about what's coming in and what's going out. And, it kind of proves my point of the whole concept of a financial puzzle, that yes, we're focused on one piece and a particular topic, but they all intertwine. And really and truly, I could always say at the beginning of every single episode, yes, we're going to talk about all the puzzle pieces because they all intertwine, and be done with that. But I try to say, okay, this is sort of where our focus is today, or whatever day we're doing the podcast. And it's the same thing that I tell clients. Clients will come in to do a review about their investments. But then what they wind up doing is they wind up telling me about, the new vehicle that they just purchased, where they were going to pay cash, but it was a good deal on the interest rate. So they decided to go ahead and finance it for a little period of time. But how does that affect, the cash flow of everything? And then, oh, by the way, I still own that small business. So if I make that purchase, is that a business deduction? So now taxes come into this, or, I put it in my name and my wife's name. Is that a good move if something were to happen about ownership? So now we bring a state in, and then, I also went and evaluated all of my property and casualty insurance. And so, this vehicle is costing me more money on the insurance side. So now we brought in that one. So what happened is that one question, we came in to talk about investments, but then we started talking about a vehicle. Well, now we've brought in all the other puzzle pieces.
Right.
And that's what financial planning is all about, which is exactly what you do twice a year with your advisor. And that's what I always encourage everyone to do, no matter what stage in life you are, no matter what phase of investing you're in, it's always good to seek advice and seek counsel as that extra set of eyes to evaluate what you're doing. Is my risk appropriate? Do I need to adjust my asset allocation? Is my goal still the same? Is my objective still the same for this piece of money? And that's really this whole point. And I wanted to bring this up at the end of the year because we've had a really good year. So as you're going into next year, we're all going to be, sitting down and making resolutions that we may or may not keep. But one that I would ask you to keep is to reevaluate your investments, and reevaluate your objective, and reevaluate your risk tolerance, and ask yourself those questions. Do I understand what I own? Can I get my money out if I needed to? Is this a regulated investment? Is this appropriate for me? And that's where I think this whole concept really comes into play, and why it's so important that I wanted to bring it up with, this will actually be our last podcast for the year. And why going into the next year, I think it's such a good piece. And I appreciate you being open and honest about your situation too, because you helped me prove my whole point. and just so you know, we did not set that up at all.
No, not at all.
But here's what's interesting. Everybody that we talk to, it's the same conversation.
Right.
Maybe not the exact same words, but it's the same end result.
There's a lot of similarities with all of us. We're working couples, and we're, we have the same, a lot of people have the same concerns.
Yeah.
There are slight differences. Sure. We don't have children, but we have aging moms.
Yeah.
And these are things, and we're both the oldest in our family.
Okay.
So we are, more directly involved with what's going on with our mothers, and part of it is financial, and which has changed over the last couple of years. So these are things that we, again, next time we sit down with our financial advisor, we're going to have to sit down and talk and lay out here. Issue A and B have come up in the last 2 years, and this is how we're handling it. How is this affecting our future type of situation? And
well, RJ, when I talk about your financial puzzle, and I use the example of you're looking at it at the Thanksgiving table, the dog comes in, hits the puzzle, hits the table, a fourth of your puzzle falls off.
Right.
That's exactly what you just said.
Yeah.
Your financial objectives up until this point have not included taking care of your aging mom.
Right.
That falling off of the pieces onto the floor, things totally beyond your control affect your financial life and your financial puzzle for you and your wife. So now you have to reevaluate, pick those pieces up. Maybe they go back in the same order and maybe they don't. And it's that happens to everyone. Maybe it's a different set of facts and circumstances for everyone, but the concept is the same.
Yeah.
And so you have to constantly be reevaluating all of the different aspects of your financial world. So
yes, we have definitely done more reevaluating in the last, I would say, 3 years than we had in the prior 20 years that we've been together.
Wow.
So, you know, it's because we were focused on our careers and, you know, things were going well. Everything was going well. There were no issues, no major problems. And over the last couple of years, life has happened. And, you know, this is what happens as you get older. And so this is why now all of a sudden we're looking and going, okay, we are paying more attention to our financial future.
Right. Well, and I commend you for doing that. And that's a great thing. That's just what I would encourage everyone to do.
Excellent.
You know, whether you're a 22-year-old person who's just gotten your first job and your first big boy, big girl job, as I call it, or if you're in that distribution phase, and you're now in your 80s or you're approaching your 90s, and you're just continuing to live life. All phases, everybody has a financial plan, and everybody has a financial puzzle, as I like to call it. So
Excellent.
That's really what I wanted to touch on today. I think it's such an important concept and such an important reevaluation, because we've had a great year in the investment world, and that has changed a lot of asset allocation models that were set months ago, and I think they need to be reevaluated. It may be that you make no changes, that you're perfectly fine with everything. Great. You reevaluated that, and now you know.
Yeah.
Or it may be that you need to take a step back. Your risk tolerance has changed in your situation. Well, now this new piece of our puzzle has come in.
Sure.
We need to reevaluate for that reason. There's always a catalyst for something, and that's as an advisor for 25 plus years, I've seen that over and over and over. And like I said, a lot of times it's a different set of facts and circumstances, but the concept is the same. And that's what I wanted to touch on with this episode.
Excellent. Contact information. Jim, how can people get a hold of you?
Sure. Several ways. An easy way is my direct phone number. You can call or text 205-510-9074. Take a look at our website. That's cmcfp.com. So cmcfinancialpuzzle.com. We're on all the social media channels: Facebook, LinkedIn, Instagram, and YouTube.
Excellent. Jim, as always, I enjoy talking with you, or even just listening when you have a guest. It's always informative and just good information that you provide. And most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.
Thank you for listening to the Financial Puzzle Playbook. Click the follow button to be notified when new episodes become available. Don't forget to follow us on social media by checking the links in the description. And contact us today by visiting our website at www.cmcfp.com or give us a call at 205-510-9074. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of CMC Financial. It does not necessarily represent those of RFG Advisory, Private Client Services, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by CMC Financial or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services, CMC Financial, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.